This is Matthew Cratter from Trader University, and today I want to talk about the biggest problem with altcoins. If you're interested in learning how crypto and the stock market actually work so you can make money in both bull and bear markets, or you just want to see what I'm trading or investing in, be sure to hit that subscribe button. So I was shocked the other day. I've been testing out this new website called Masari.io. There's some free content here, but there's also some paid content. And if you look up, I decided to look up the daily transaction fees for various cryptos. And I have them sorted here by 24 hours transaction fees. And these are basically the fees that people are paying to get their transactions done. In other words, the fees they're paying to get access to each block of the blockchain, or access to the blocks over 24 hours is how you could look at it. And I was absolutely shocked by the low demand for some of the altcoins, like Litecoin, for example, BCH, BSV, XMR. For example, Bitcoin Cash in 24 hours, the last 24-hour period, generated just $60 worth of transaction fees. Litecoin, $430, Bitcoin SV, BSV, these are forks of Bitcoin, just $93, Monero, $380. And what this shows is that there's just not demand for these blockchains or these cryptos. I think this is one way of looking at it. The other way of looking at it, of course, is to look at the miner revenue for the past 24 hours. And if we look at these same coins, miner revenue for BCH, just $223,000, for Litecoin, $337,000, etc. Now contrast that with Bitcoin and Ethereum. I used to be a bit of a Bitcoin maximalist. I'm getting very interested in Ethereum, and I don't think you can ignore it anymore, or I certainly can't ignore it anymore, especially when you use this metric that we've just been discussing, the 24-hour fees generated for the crypto as sort of a proxy for demand for the product or demand for space on the blockchain. As compared to Bitcoin BSV, for example, it's generated just $93 or $94 in the last 24 hours. Bitcoin itself, BTC, generated $369,000. So it's just many orders of magnitude. And then Ethereum is actually another order of magnitude above that. Ethereum generated $3.7 million in fees in the last 24 hours. Now, a lot of this activity on the Ethereum blockchain is being driven by DeFi, which I've talked about in a few videos. This is one reason I've become so interested in DeFi. But basically, you can think of Ethereum as almost like an operating system, and then you have all these different algorithms or apps or protocols, they're often called, that are training on top of them. Decentralized banking and trading protocols. So for example, Aave, Maker, Uniswap, which we've talked about in some other videos and I'll continue to talk about. But this shows that there are basically really two categories for cryptos. There's Bitcoin and Ethereum, and then there's everything else, which doesn't generate any fees. By contrast, the mining revenue for Bitcoin over the last 24 hours was 10 million, and the mining revenue for Ethereum was 8, call it even 9 million. And so if you add up all the transaction fees and the mining revenue, so you basically get a reward for mining blocks, and then you get a transaction fee. Ethereum is now generating more in mining revenue plus transaction fees per day than, did I say it backwards? Ethereum is generating more of this combined transaction fees plus miner rewards than Bitcoin. So Ethereum currently generating about 12, 13 million in daily revenue, and Bitcoin about 10.3, 10.4 million. So on this metric, Ethereum has become more important than Bitcoin in terms of demand for its mining services and demand for space on the blockchain. Now, I think one reason for this is that there's just a lot more transactions going on with Ethereum because of DeFi, as we said. What Bitcoin is morphing into is sort of a form of digital gold. And I believe it's following Gresham's law, which basically says that bad money drives out good money, or the other way of thinking about that is that people will hoard good money, hard money, scarce money, and take it out of circulation. And this is what, of course, has happened with silver dollars and rare coins, silver and gold coins in the U.S. you would never spend a gold coin at the grocery store. You would take it out of circulation because it's worth much more than its face value. And I think something similar is happening to Gresham's law. It's becoming a form, something similar is happening to Bitcoin, I should say. It's becoming a form of digital gold. People are buying it and taking it off the market, and hence you have lower transaction fees for Bitcoin than even Ethereum. I think this is borne out if you look at the so-called HODL waves that are put out by Unchained Capital. What we have here is this black line is just the price of Bitcoin. Here is the time axis going from left to right. And then we have these different colored bands. This top blue band right here is all the addresses, all the Bitcoin addresses that have not moved their Bitcoin in 5 years or more. The next one down is 3 to 5 years, etc. And what we can see is that these are slowly slanting down. If you look at every level, they're usually getting lower, which means that people are taking Bitcoin off the market, off the secondary market. They're putting it on hardware wallets, and they're hodling it. So I think that helps to explain why Bitcoin just has less demand for fees. Now, one could make the same argument that people are taking Litecoin out and hodling it. I just don't think that's true, especially when you look at the market cap and the daily trading volume. So another problem for these altcoins, another problem with having very low demand for the blockchain and low mining revenue, is it makes them much more susceptible to 51% attacks. And I've talked a lot about that in other videos. You can Google that. But basically, to attack Bitcoin currently would cost about $15 million for a 24-hour attack. These are just estimates, of course. And that's actually not a lot of money for a state actor to do. If there were a 51% attack on Bitcoin, they could just basically slow down the blockchain. They couldn't steal anyone's Bitcoin, and they couldn't create more Bitcoin or increase the supply, but it would definitely cause problems. Ethereum is next down in terms of 24-hour attack cost of 13 million. You compare that to some other coins where, for example, BSV, would just cost you $177,000 to attack it for 24 hours, and so it goes as we go down the chain. Let me just refresh this really quickly so I can. So if we look at some of the other attack costs, for example, Ethereum Classic, $129,000 to attack. Bitcoin Gold would cost you just $5,000 or $6,000 to do a 51% account on it. Feathercoin, FTC, just $1,000 to do a 51% attack. So that's another problem when you don't have a network where it's very expensive to mine the coins. People always say that Bitcoin wastes energy and it's very expensive to mine. You need industrial equipment now, and you need very low cost of electricity. But what this means is that the network is very secure. It's generating significant revenue in terms of transaction fees and miner reward revenue every 24 hours. And this is a proxy for the security of the network. I finally wanted to close with just another interesting metric that was on here, which is the percentage move needed to clear $1 million. And by this, it means to buy $1 million US dollars worth of the crypto, or to sell $1 million worth of the crypto. And we can see here that Bitcoin is still the most liquid, not a lot of slippage. This is basically a measurement of how much you would move the market by trying to get in or out with $1 million. Bitcoin, you would just move it by 0.03%, which is tiny, is a very, very liquid market. Ethereum is about 3 times that, but still very, very liquid. And then as you drop off Litecoin, you'd move it close to 0.75%. Bitcoin Cash, Bitcoin, and BCH and BSV, you would move the market anywhere from 2 to 2.4%. Now, this is huge slippage, and this is one reason that institutional investors will put all of their money, if they have to choose a Bitcoin, they will choose BTC. They will never choose BCH or BSV. And the more institutional investors choose BTC, the more liquid it will become, the larger its market cap will become. So this is really a winner-take-all sort of thing. And I would still make room for Ethereum, obviously, and the whole DeFi movement. But as a store of value or anything like this, institutional investors, large amounts of money, and $1 million is nothing for a large institutional investor. They need to be able to move hundreds of millions and even billions. But this shows you that something like Monero, for example, XMR, the market would move 8.5% if you tried to move in $1 million or take out $1 million. And so this just immediately crosses it off the list for institutional investors. So I think this is very important. I always get emails saying, do you like Litecoin? Do you like XMR? Do you like various coins? I think it's important to look at these metrics. The 24-hour attack cost, how much the market will move if you try to get in or out. In other words, the sort of slippage that an institutional investor could incur. And then also, I think it's really cool to look at 24-hour fees, transaction fees, as well as mining revenue, just as proxies for demand for the product, demand for space on the blockchain. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell so you'll be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for listening, and I'll see you in the next video.